Good afternoon and welcome to the Wall Street Crossover Show, sponsored by Admiral Markets and starring their market commentator Darren Sinden. I believe you were on the show yesterday, but I wasn't. Did I miss anything?
You may one or two things may have cropped up there.
Okay, well, because I don't like dull markets, and I was sort of winding down for the summer and everything else. But we seem to have had a bounce back this morning. Any explanation?
Well, as we'll see in a minute, we've seen some action, a bit belatedly by the Chinese authorities. I also think it's fair to say that certain of the moves yesterday were just outrageously
negative. Too much too soon.
For the Dow to open down 1,000 points was a nonsense, and Apple printed down to, I think I'm right in saying $92. There are some ludicrous moves. So we swung far too far one way. Now we're perhaps correcting back to the upside. The balance probably lies somewhere in the middle between those two extremes, I'd say.
Okay, well, let's have a look at what you've brought with you.
Okay, so in case you weren't aware, it was hard to avoid it really, but there was a further slide in Chinese stocks overnight. At one point, the CSI, the principal futures contracts in China, was down by 10%, limit down. In fact, we closed off those lows. But interestingly, other markets in Asia started to stabilise. There was a positive finish in Australia, I believe, and Indonesia as another example of a market that bounced back. Subsequent to those closes, we've seen some, as I suggested, some interest rate action from the People's Bank of China. They've cut their outright interest rate by 25 basis points, or 1/4%, and what they call the reserve requirement by 50 basis points. Then the reserve requirement is the ratio of assets to loans that banks have to have on deposit with the People's Bank of China to borrow money there. So, so basically adding liquidity, making it easier and cheaper to borrow money, and that's engendered a decent bounce across the board, really. We also had some data out of Germany today, which on another day would probably have warranted a close scrutiny, but to be fair, it's all about the very biggest macro picture at the moment, and even something as important as the German GDP is probably on the back burner. Nonetheless, we had the GDP numbers for the second quarter on a quarter-on-quarter basis. Came in at plus 0.4% against a forecast of plus 0.4% and a prior read of plus 0.4%. We've seen a number of these figures coming out, and they've been conveniently in line and with both forecasts and prior reads. I would be disappointed if I were sitting in Frankfurt looking at that, but I suppose it could have been worse, is the honest answer.
And then, it may become worse if, obviously it's a rear view mirror view on the German economy as well.
Oh, absolutely, yes, of course it is. As we know, they're exposed to Asia through their export-led economy, and a downturn there would be potentially negative for that. And then we had the German IFO survey. This is the second of their survey-based data points that we look at closely, along with the ZEW. First of all, then the expectations. Looking forward, these numbers are all related to August. So the sentiment indicator, which is what this effectively is, came in at 102.2. That was slightly ahead of the forecast, 102.0, but a fraction below the prior read of 102.3. So no better, no worse, really, in terms of the outlook. I do wonder, though, if they surveyed people this week, what the read might have been. And then in terms of how people were feeling about the current climate, the current assessment number, 114.8, that came in, and that was actually well ahead of the forecast of 113.9, and the prior read, coincidentally, also 113.9. So people were happy about how things are going now, perhaps less impressed looking forward. We'll take it all with a pinch of salt today and come back to it next month, I think.
Okay, and the movers, the big one, obviously, the DAX.
Yeah, well, I thought not a great deal of point in looking at individual stock moves while the markets are like this. So the DAX up around 4.33%, back above 10,000, at 10,066, and a lot of those gains were bolted on once there were rumours of a rate cut in China. Once the official announcement came on, then the markets also played a further bit of catch up. And if we look at an individual sector that's performed very well today, the Stock 600 Banks Index, that's ticker SX7P, 196.9 recently before we came on air, up around 5.63% on the day. And banks have bounced basically because contagion fears have subsided, or at least they have for now. And there's something of a relief rally. I dare say a fair bit of short covering as well in that sector to help them on their way.
Okay, well, let's go on to the M&A rumours and movers.
Okay, well, just wanted to update people on a couple of stories that we talked about previously. First of all, Monsanto of the US, that's ticker MON, raised its bid for Syngenta, ticker SYNN in Switzerland, to around 470 Swiss francs or $503. Viewers might remember that Monsanto is the world's biggest agrochemical group, and they're looking to take over their Swiss rival Syngenta. Syngenta, the share price is up 391 francs this morning, up about 9.48%, but well below that 470 Swiss franc potential offer. And the reason is that Syngenta's board haven't opened talks with Monsanto. Monsanto are hoping to get them to the table. They previously offered to pay 449 francs per share for the company. They've also offered to put more cash down and less stock than earlier in the year with their previous offer. So that may sway the Swiss, but they of course could choose to remain ambivalent to that and ignore Monsanto completely. And staying in Switzerland, Zurich Insurance, ticker ZURN in Switzerland, have bid a revised £5.6 billion for the UK's Royal Sun Alliance, or RSA Insurance as we must now call it. That offer's worth around £5.50 a share, and RSA stock was trading around 517 pence today, up around 4.6%. Interestingly here though, the RSA board is willing to recommend the revised offer to shareholders, and that's seen as something of a coup for their chief executive, the ex-boss of RBS, Stephen Hester, who joined the RSA in February 14 to try and sort out the group. And I think a trade sale for £5.50 will be seen as something of a feather in his cap if it goes through.
Okay, well, that's a rare good news there. And also rare sort of M&A in the UK space. So that's without any fuss. Onto the data points.
Okay, well, I mean, even we've got a slightly fuller calendar today in the US, but again, I think the data points are largely relevant in the context of the bigger moves in the market. But for what it's worth, first of all, we've got new home sales for July, looking for a forecast of around 516,000, sharply up from the prior 482,000 for June. And accompanying the new home sales is the Case-Shiller house price index for June. This is the month-on-month number, and the seasonally adjusted one. There are about 5 figures that are released at once, but we'll focus on this. And we're looking for modest gains of around plus 0.1% versus a slight dip that we saw last time of minus 0.2%. And then consumer confidence, always key to the US economy. This is the figure for August. We're looking for a read of 94 even versus July's slightly disappointing number of 90.9. Again, perhaps the Fed will be watching this to give themselves an idea of how the US consumers performing, and perhaps that one might feed into some clues about how the underlying US economy is likely to perform.
But all those data points come in as expected. It'll actually probably be a net positive for the market as well. So we're all tipped in favour of better numbers there.
Yes.
Okay, well, let's go on to the pre-market movers and levels.
Okay, well, once again today, I'm just going to look at how the index futures are looking to open, or how they've been indicated to open. So we start with the S&P 500 futures around 1936, up around 3.5% after that China news. So they have been higher than that pre-market. And then NASDAQ, remember this was, well, you won't remember because you weren't here, but yesterday this was the one that was called down the most of the US equity.
It was down 4%, I think, yesterday. So it's up. It's already.
Yeah, exactly. Up 4.4%, around 4,167.50 is what it's expected to open. And it's, we haven't got to be too clever to see why US equities have seen rallying sharply on China rate moves and the gains made in European indices, and that's likely to filter through into the US market this afternoon. If we look at the levels to watch today, as far as the cash indices are concerned, which is what we're looking at here, it's been a wild ride, and the charts aren't telling us too much because we made such big moves and gaps yesterday. But we'll go with 6,000 on the downside in the FTSE, if nothing else, for its round number value. Plays 6,151 to the upside. For the DAX, 9,760 is the level we'd need to break back below to make further losses of any consequence anyway, and we play 10,125 to the upside, which could easily get taken out today, I would have thought. For the S&P, we look at 1,893 now as the downside level, playing 1,926 to the upside. It is a wide range there, but given yesterday's volatility, I think we can live with that for the moment. And in the Dow, I've gone with 16,120 on the downside, plays 16,220 to the upside. But again, I think the upside level could easily be taken out if we have a good solid session this afternoon.
Okay, and on the currency front?
Okay, for currencies, euro dollar, just pausing for breath really after the last couple of days where it's roared away. 114.54 now will be our downside level. If we are going to make further gains, we need to take out 115.49 on the upside. Aussie dollar, US dollar, that's probably the calmest of the bunch at the moment. 72.00 now on the downside, plays at 72.75 to the upside. In dollar yen, we've got 119.60, plays 120.32, but that effectively printed down to a 115 handle yesterday afternoon. So we've regained our composure, but there were wild moves.
They flushed everybody out there as well.
Well, absolutely,
all the
but
bulls. It's a stale market.
Given that's the pair between perhaps the fourth biggest economy in the world and the first biggest economy in the world, it's a very surprising move. And in cable, cable's managed to re-establish itself above 157 and has the potential perhaps now to push on further. So we look for 157.45 as our downside level versus 158.05 to the upside. And my focus again would be on the upside there.
Okay, and the new extra feature we have?
Yep, in focus. What are we watching? Well, I thought we'd try and take a look at the sort of the damage that was done yesterday and how we're going to dig ourselves out of the hole if we are. So the headline there: global markets have moved into oversold territory. What we have here on the chart is a series of very narrow global indices. So Asia 20, Japan 50, the top 55 European shares, the top 50 UK, and the top 100 US shares as an example. The orange bars show the change on yesterday's business in the number of stocks within those indices that were in a bullish trend, and the blue bar shows how that's left them. So the Asia 20, not a single stock in a bull trend as of the close last night. In Europe, we can see 21.7% of the stocks remained in the 55 stocks there remained bullish, and in the top 100 US names just 8.51%. Even if we use a conservative 20% oversold boundary, which is the dotted blue line there, you can see that most of those, with the exception of the European top 55, were inside that oversold boundary. And truth told, the proper boundary to use here is 32%. So massively oversold in these markets. The question is, how much damage will today's bounce repair? Because of the way that these figures are calculated, they will look better tomorrow, but stocks have got to move up by a fair whack, probably well above what we'll see today, to get back into or get out of an oversold position.
Plus, it could be take much slower, longer time than people currently expecting. So just it gradually fades into the payrolls numbers and then towards the Fed. So it could be an extended process.
Oh, absolutely, it's not going to repair itself overnight now.
Darren Sinden, market commentator at Admiral Markets, thanks for your input today, and we'll be back with more tomorrow.